Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Ponio, certified financial planning professional, the Cap in Capitalize. And on today's episode, we are going to be revisiting the importance of emergency funds. But as always, your free advice of the week. For your summer vacations, since this is the start-ish of summer, if you are going on a trip, make sure you set your budget and work backwards in regards to setting aside a monthly dollar amount so that you don't risk ruining your finances over the fun stuff. And you're going to want to plan for it the same way as you would prudently for anything and everything else. So I actually heard a quote a couple days ago, and of course I'm saying this, I'm probably going to completely butcher it, but the quote basically alluded to the idea that everyone has a spending problem. And what the guy, and I'm blanking on the guy's name even, so I can't even give him credit, but the whole idea is it doesn't matter if you're in debt or if you are making more money than you're spending every month. You are going to have a spending problem, and it's your choice to basically align yourself with the problem that you're going to lie with. And I thought that was a really interesting way of basically conceptualizing the idea regarding basically what problem you're going to sign up for. And when it comes to emergency funds, actually, I remember, this must have been like 3 or 4 years ago. There was an investor, Vitaly, and I really butcher his last name every time. I think it's Knopfson. If I butchered it really bad, Vitaly, I'm sorry. But he actually brought up this idea of anytime he has an intermediate expense coming down the pike, he allocates every single month where that money is going to go. And what's cool is it's all automated, out of sight, out of mind. You don't really have to think about it. And so for summer vacations, again, summer is just starting, but think about this for your next summer vacation or even the summer vacation after that, or even after that. Because if you automate all of this aside, you're never going to have any issues with your financial situation, and you're going to basically get out of your own way. So enough of that free advice for the week. Okay, it's time to get back into the emergency fund conversation. And this is a conversation that I have a love-hate relationship with, because in many ways, I think to myself, okay, emergency funds, great. I've talked about this a lot in the past. I keep bringing it up. But then I also remind myself how valuable it is, and how just when you think you're getting too comfortable and cute with an emergency fund, or just the concept of an emergency fund, it's a smack. You get a smack in the mouth that tells you why it's so valuable. So what I want to do is just start with just the basics, taking it from the top, and then we'll get into some of the more exciting things with an emergency fund. Because emergency funds actually evolve as you grow your net worth. And again, we'll talk about that later in this episode. So why are they essential? I can tell you, when I started in my career early on, and I was reinvesting everything I had into myself and actually going backwards in the debt game, because I couldn't afford to do anything other than that. When I was able to save up a couple months of emergency fund just to breathe, that was arguably one of the most fulfilling feelings I have ever felt, financially speaking. You want to prevent on using this at all costs, unless it's an absolute dire emergency. Now, I want to go a step further with that because there are some things that you may think are an emergency that aren't actually an emergency. And I don't want you to open the door too much to what you think actually is an emergency, because then you get very loose with, well, frankly, just with your emergency fund in general. And you don't want to shoot yourself in the foot, because next thing you know, you no longer have an emergency fund. Now, how much should you save? I've said it before. I will say it again. Generally speaking, 3 to 6 months in emergency funds. So if you spend $4,000 a month from an expense standpoint, you want to have that floating in your checking account. Once you have that set aside, 3 to 6 months of that. So 3 times $4,000 is $12,000 to $24,000 set aside in your savings. Couple things with that. If you are, and let's get a little bit more specific here. Let's say that you're single, don't have any kids, you're in a pretty low risk job bodily. So if you're in administration, or if you are pushing paper, okay, doesn't really matter. Something where if you were for whatever reason disabled, you could still do your job. It's not really that big of a deal. You could probably get away with having 3 months. Now, if you, let's say, are married and you're the sole provider and it's a very physically demanding job, and if you slipped a disc, you're out for a while and you have no way of making income, well, then you're probably going to have to look at the 6 month side of things and maybe even a slight bit more. Now, that's what I would say if you are, I don't want to say an everyday employee, but if that's a pretty stereotypical job or career path. Let's talk about freelancers and business owners, because it's a little bit different when it comes to freelancing and owning a business, because it depends on the business. So regardless if you are a freelancer or a business owner, if you have a stable stream of income, generally speaking, that 3 to 6 months is still going to apply. However, let's say that you run a business and from a cash flow perspective, you're making way more than you're actually spending every month. So let's just paint the picture here. Let's say that your business spends $35,000 a month, but your business actually makes $50,000 a month. That's a lot of cushion between what you're making and what you're spending. 3 to 6 months, do I think that's fine? Totally do. But let's say there aren't a lot of ancillary expenses with that. I can make an easy argument. You may only need 2 months. You may even only need 1 month, depending on the type of business and your circumstance. Now, on the flip side, let's say you run a business and it's extremely cyclical. So let's say that you're running a construction company. Or actually, let's say you're not running a cyclical business, but you're running a business where the majority of your revenue comes only like 1 to 2 months out of the year. Like a CPA. A CPA makes the majority of their money from February 1 through April 15th. Why? Because it's tax season. That's just the way that it works, okay? Maybe they get a little bit during extensions or some consulting here and there, but the majority of what they make, February 1, April 15th, done. I could argue that you may need up to 9 months, maybe even up to a year of expenses. I mean, Bill Gates was famous for having a year of expenses set aside at Microsoft, and Microsoft was making way more than what they were spending every single month. So if anyone, you could have argued that Bill Gates was way too conservative on how much cash he had in Microsoft's bank. But, I guess joke's on everyone else because he's an absolute billionaire and I still have a mortgage. But the point is 3 to 6 months, that's the general rule of thumb. But once you understand your cash flow, you can tweak that, because there is such a thing as having too much cash off to the side. So we're going to pause right there. And then when we get back from the commercial break, we're going to get into building or replenishing your funds. And then we're going to take it from there and get really, really exciting on the evolution of your emergency fund. So don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back to the show. We're going to get right into it on building or replenishing your emergency fund because life happens. Now, there are a couple strategies that I want to talk about when it comes to rebuilding your emergency fund or building if you haven't had one in the first place. So we're in the world of automation, whether it's a subscription-based model, something where you set it and forget it. That's fine, but when it comes to like an emergency fund or with money, and actually this is something that a lot of people think like I'm totally against automation. I'm not. But when it comes to savings, it's the whole idea of trust but verify. If you're going to automate, that's fine, but you always want to make sure that you're staying on top of the automation. And I also want to take that a little further because I've seen a lot of people, and actually this is in just my direct line of work. There's a lot of technology out there that helps, quote unquote, planners do better by their clients. Again, this is all in theory. Well, I'm not against technology, but if you have technology that compounds on top of technology, that compounds on top of technology, et cetera, et cetera, et cetera. What ends up happening is a lot of people in our industry, they actually lose the actual gift of knowing what they have to do for clients. And I've actually seen this before where software would go down and then an advisor just doesn't know what to do, which is that's beyond insane for me. Like I always tell people, you should be so good at what you do that if the world just shut down, all you need is a piece of paper and a pen, and you know exactly what you need to do, or you can at least illustrate what you can do for people. Because simplicity is king in this world. But going back to the automation side of things, like once you have that saved up, you're going to want to shut off that automation and send that money into other appropriate places when it comes to money. Now, where to keep your emergency fund is extremely key. So nowadays, you got a lot of these online savings accounts. For those of you that have listened into the show for a while now, you know I'm a huge fan of that. And even though, as of this recording, interest rates may be slightly lower than they have been in recent past, you're still going to get a higher yield on an online savings account versus a traditional savings account or a bank. Okay. You could go and buy a money market fund or a money market account. You could even, I could argue, ladder CDs with maybe the last bit of your money to try to squeeze out a little bit more return. But frankly, for an emergency fund, all things being equal, I would much rather have a little bit more liquidity versus trying to make a smidget more, but then your money is locked up in the form of a CD or an illiquid account, okay? So just keep that in mind. Online savings account, 10 out of 10. Now, as far as what qualifies as an emergency expense, we talked about this right before the commercial break, but it's worth really getting you to think about what qualifies as that. I've actually seen people, I don't do this personally, and I don't do this for clients, but I've seen people treat their finances when it comes to an emergency fund almost like a mission statement. And they actually write down what would qualify as an appropriate emergency to tap into the emergency fund. Again, I don't do that, but I could see immense value. And if that keeps you on track, by all means do it. And obviously you've got to avoid the temptation to dip in for non-essential costs. Now, once you have it saved up, you obviously want to pretend it's not there. But remember what I said, the whole trust but verify thing. If you have an online savings account, you are going to be earning a pretty decent amount of interest on that relative to other savings accounts out there. So what you could do is once your savings is built up enough, so let's go back to that $24,000. If it's 6 months of $4,000, if you had that money set aside, and let's say that it's earning, gosh, I don't know, a couple $100 a year, okay? Maybe $500 a year. Well, what you could do is you could automate that interest going into either your checking account, an individual retirement account, a Roth IRA, an investment account. But the point is your emergency fund starts to make you money. Didn't really think of that before, did you? I think that's kind of cool. Now, as far as how to reassess things, periodic reviews are obviously mission critical when it comes to an emergency fund or anything in the world of finance. But what I would do is once a quarter, I would just set 3 or 4 minutes aside, ask yourself, how much am I making? How much am I spending every single month? And then make sure that your emergency fund actually matches what you're trying to accomplish. So, for example, let's say that you're spending $4,000 a month, just keeping with that theme. And let's say that you're making about $4,000 a month, or maybe slightly more, maybe $5,000 a month. And let's say, single, no kids, right? Not a lot of responsibility other than outside of yourself, within yourself. So if you have 3 months set aside, $12,000, you're probably pretty good. Now, do you need any less than that? No. Do you need any more than that? No. Now, let's say that you get a pay raise and your expenses are still the same, around $4,000 a month. But let's say now that you're making $6,000 a month. Okay, you probably still need that $3,000. Now, let's take it a step further. Let's say that you're now making $8,000 a month, but you're only spending $4,000 a month. All right. Do you need 3 months worth of emergency fund? Again, in theory, on paper, I would say sure. But in reality, you probably don't need as much because you're making an extra month above and beyond what your expenses actually are. So you may be able to get away with 2 months. Let's say that you're making $12,000 a month, but your expenses are $4,000. I could argue you may only need 1 month set aside just for comfort. And then anything above and beyond that, you want to invest it as aggressively as humanly possible. Or you want to invest it or set aside as appropriately as possible for maybe a down payment on a home or a car, or you're saving up for schooling or a couch, whatever the case may be. But what happens over time, this before we close this episode out, is traditionally you need that 3 to 6 months. All right, we've established that. As you start to make more, you could argue that you don't need as much in the emergency fund. So maybe instead of 3 to 6 months, maybe it's 3 to 4 months. But then what happens is, let's say you're making more money than you're spending every month. And then over time, you get to this point where your portfolio actually pays for your monthly expenses every month on top of what you're actually doing from your day job or your business. So then what happens is you have this moment, 3 to 6 months, 3 to 4 months. And then what basically happens is you don't really need any cash at all set aside because your portfolio, like if you were totally brain dead and physically inept, your portfolio could pay for every single expense in your life. And then what happens at the very, very end is as you start to make like big money, you have what we call like institutional amounts of cash. So if we have clients and, we have clients that have, net worths in the tens to $20 million range, at that point and above, the whole 3 to 6 months thing, I can make an argument for it, but it kind of goes out the window because they're not necessarily spending more than say, the average person. And so then it becomes a question of like, all right, how much do you need as a percentage of cash of your net worth, off to the side? And so maybe that's 5%, maybe that's 10%. I don't know. But I have seen that over time, once you hit that level, you're kind of like a walking institution or an endowment or a pension. And that is something that, it's next level. I mean, look at Warren Buffett. Warren Buffett and Charlie Munger have said forever that due to the size of Berkshire Hathaway, which is valued at about $1 trillion, which is insane, they will never have less than $20 billion set aside just because. Now, again, you could argue for if that's for better or worse, but I guess joke's on everyone else because, Berkshire Hathaway has grown at 20% a year since Warren Buffett took it over in 60 years ago, which is insane. So that does it for the revisiting emergency funds. It's one of these things that for some of you that have been tuning in for a while, you may think, hey, you know what? Like, I get it. Emergency funds are valuable. For some of you tuning in for the first time, I hope this was immensely valuable for you. But regardless of where you stand in the experienced realm of finance, just know that out of everything within your personal financial situation, emergency funds is something that is not only the most boring, but arguably the most important. And don't ever overlook it. So, as always, I'm your host, Chris Panayiotou, certified financial planning professional, the Cap in Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Panayiotou, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Christopher Panayiotou is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. Any other individual or company mentioned in this podcast are not affiliated with Capitalize Your Finances or LPL Financial.